Thank you for attending our home buying webinar presented by Provident Credit Union. Our session today should last for 1 hour with a Q&A session at the end. During the presentation, you'll have the ability to send questions to our webinar staff through the questions pane. Simply type in your question and click send. We'll address all Q&A at the end of today's session, and a copy of the slide deck will be emailed to all attendees in about a week. Our first presenter is David. Would you like to introduce yourself?
Hi, Amanda. Thank you. I'm a senior mortgage consultant with the credit union. I've been with the company 26 years, and I handle all real estate types of loans here at the credit union. Thank you.
And our next presenter is Nick Rowe.
Hi guys, my name is Nick Rowe. I'm the lead of Altos Estates Group. We're a top producing real estate team here in Silicon Valley in the Bay Area, and we help lots of first-time home buyers purchase their first home. So our goal really with this seminar is we're going to have a few main points that we want you guys to be able to walk out of here and feel empowered after coming to this first-time home buying seminar. So one is going to be going over home ownerships, the objectives of why to become a homeowner, and then how to achieve those goals. We're going to introduce the mortgage side. So David's going to run through the whole process of getting pre-approved and what the loan process actually looks like. Then we're going to shift back over to me and talk a little bit more about what to do when you're ready to start your home search. I'm going to go ahead and summarize the home buying process as well. And then we really want to help you understand what to expect after we get the purchase contract accepted, because in real estate, only half the battle is finding the home and getting the offer accepted. You don't win the home until we get you guys the keys. So the steps to successful home ownership is really going to be one, educating yourself about the home buying process. We want you guys to always feel like you're in the driver's seat for this transaction. Buying a home is pretty complex, especially the first time that you get it done. There's going to be a lot of different terms, a lot of different processes. So we want to make sure that you guys feel completely in control. And the way that we do that is going to be through education. So this is a great first step on that educational journey. We also want you to learn about how to apply and obtain a full pre-approval and what that means. David's going to go over that a little bit as well when we get to the mortgage side. But in the Bay Area, when you're competing on offers, it is extremely important that you actually have that pre-approval before you're putting the offers in, or most listing agents aren't even going to look at your offer or take you seriously. We're also going to go through setting your budget goals and what that looks like. Why to work with a professional real estate agent, and how we help you navigate the transaction, navigate the due diligence, and understand what you're buying. And then how we build out a search perimeter. So it's a little bit more than just looking at Zillow online, but how to take those serious steps on finding the right home for you as a first-time home buyer.
So thank you, Nick. So Provident is the 108th largest credit union in the U.S. We started as the California Teachers Association Credit Union back in 1950. And we still serve California teachers. We are the credit union for Northern California for the CTA. And we have 21 branches, primarily in the Bay Area proper, 5 Bay Area counties. We have $3.5 billion in assets, and we have earned a sound name for safety and soundness throughout the years. So why choose Provident? Well, we're a direct, experienced local lender. We have been doing real estate loans for years. I mean, I've been here 26 years, and that's all I've ever done here. Prior to me coming on board with the credit union, we were doing mortgages way before that. So we're an experienced lender. All of our folks have a ton of experience. We have underwriters that have been in the business 20, 30, 40 years. So as a result, we can close quicker, and we're more more service friendly. We know what we're doing. We know how to close loans. We're also competitive rates and the terms that we offer. We're flexible. We have unique features in our loan products. We have a unique feature called a movable mortgage. And once you become a client of the credit union, I'll explain that to you. But it's a very unique feature that we have trademarked, and it's only available at Provident Credit Union. We have streamlined refinance, discounts for relationships, lower down payments, programs allowed and provided. We are awarded Best Credit Union California Forbes list in 2021. We have a 5-star rating for 114 consecutive quarters from Bauer Financial. We're rated top 11 credit unions in California, and we are A+ rated for financial health and stability as a healthy credit union. Yes. Sorry, tongue twister there. The pre-approval process is pretty straightforward. Basically, you got to start with a loan application. That's how we organize the review process is with the beginning of a submitted loan application. There, you're going to provide information about yourself. Your name, address, date of birth, social security number, your employment, your assets, those kinds of things. I'm gonna then take that information and review all the data that you submitted. Unfortunately, without the supporting documents, I can't complete my pre-approval process. So it's very important that not only do you complete the application, but you submit all the documentation that's being requested through our mortgage portal. Once I've gotten all the data and I've reviewed the information, I'm going to run the numbers first. Then I'm going to call you and discuss the preliminary results and discuss, where we should be in terms of should we order credit. I typically do not order credit at the very beginning. I don't want to order credit until I know that on the surface we could do something for you. We'll then run the credit, and then once I get the credit report and the results back, I'll finalize your debt levels and your credit scores, and then establish your buying power. Once we've established the buying power, I will then prepare a pre-approval letter that you'll get, and that'll be the signal of the beginning of the search process for you. You'll provide that to Nick, and then he'll start shopping. He'll start running searches to try to fit your buying power needs. Some of the key factors that we look at when we're going through the pre-approval process. Your income is very important, obviously. The type of income is going to depending on the type of income, the income's going to be or can be reviewed differently versus somebody who's W-2'd or salaried versus self-employed individual. You can purchase as a self-employed individual. We use different methodologies to calculate the income that we can use for underwriting purposes. Just as important as your income is your credit score. Credit score is very important. Now, the credit score is provided by one of the 3 bureaus, Equifax, TransUnion, and Experian, and we run all 3. So when we do a credit score inquiry, we're running credit from all 3 bureaus, and then we're taking the 3 scores and then taking a look at the middle score, and that's the one we use. Okay, so credit score is going to give us an indication about your credit history. It'll tell us a little bit about your credit utilization, give us your credit score, tell us about the recent inquiries, and tell us about debt. One of the most important things is giving us information about your debt, the kinds of balances you have with your credit cards, auto loans, student loans, personal loans, those kinds of things. Really important because the debt is a critical part of your debt to income ratio calculation. And that's one of the key factors in the underwriting process. And then another big point in the pre-approval process to make sure that you've got sufficient assets. There's 3 buckets of cash when you're buying a property. First bucket is the down payment, obviously. Second bucket is the closing cost. And the third bucket is what we call reserves. Lenders want to see that you have enough funds for a rainy day. So they require reserves, not require you to spend it or move it. It's just that you have to have it after we close. So there's 2 primary different types of mortgages: a fixed rate mortgage, which is the mortgage where the interest rates are fixed. They're in during the entire term of the loan. And they're typically higher than an adjustable rate mortgage product. They do provide you with more security stability. You're going to know what your payment is day one and day 300. You're going to know what that interest rate is at all times. It's never going to change on you. And typically, folks that are looking to purchase their home and stay there for quite a while, they're going to be looking at this product. A more affordable product is going to be the adjustable rate mortgage. And there's all different types of adjustable rate mortgages. Some require higher levels of qualifying. Some will qualify you at start rate. And we could talk about all of that. But typically, these mortgages are offered at lower rates and lower fees than fixed rate mortgages. So there's an option there to choose either one. Typically, once we complete your pre-approval, then I'll be presenting you options for both. You'll be making your decision about what product you want to select. And I'll coach and counsel you on based upon your preferences and which one may work best for you.
Cool. Thanks for that, David. I think that was really informative about kind of the initial pre-approval process and what they look at. So a little bit about our team. We're going to be a top producing real estate team in the Bay Area, like I said. And we really built this team to create a process for you guys as first-time home buyers that it feels more like a concierge service. So what I mean by that is because I'm not just a single agent, we have dedicated showing agents. When you're working with us, you're going to be able to see the properties on your schedule. And we're going to make sure that we're going through all the steps with you to make you feel comfortable when you're buying the new home. So that includes the education, looking at the due diligence documents, negotiating. We have a whole synergy for the team to help you succeed and win your home in the Bay Area. And then why choose me and my team? Well, we have a proven track record that helps you guys compete and win competitive deals in Silicon Valley. We're a top producing team. We did 30 million in transactions last year. We have a very education first approach, which means that we want to keep you guys in the driver's seat. We know in real estate, a lot of times it can feel, like I said, like a lot of information coming at you at once. But the reason we do all of that education is we really want you guys to feel comfortable with every decision that you're making as far as real estate. Our number one goal is we don't care if you buy a house or if you don't buy a house. We want you to feel comfortable with the decision of saying yes or saying no. We also give you guys some pretty incredible tools to succeed. So here with our team, we have a lot of technology that we give to you guys that lets you book tours directly with us. A lot of buyers, they think that when you book a tour on Zillow or Redfin, you're going to be working with your agent. But oftentimes that's actually going to just assign you as an agent lead to a different team or a different agent. So we built technology that lets you coordinate showings with us. It lets you request due diligence documents and ask questions with AI about those different disclosures with us. It lets you write offers and track the offer process. And then you can also see what's going on with real time and communication all in one place. So we built tools for you guys where it's really like a one-stop solution where all of your real estate is going to be in one portal for you to access throughout your real estate journey. Now, let's go ahead and switch gears a little bit back into how we like to build out the search, because I'm sure a lot of you, are looking through different real estate sites right now. Even before you're getting into real estate, a lot of times we scroll on Zillow or we scroll on Redfin when we're getting an idea of what we like. But when we're ready to get serious about buying a property, we always employ different frameworks than just the casual scrolling to help us really dedicate what we need to do to find a good area and to find a good property that are going to match our criteria and our goals. So I have a few different frameworks here that we always like to work with our buyers to help them get into the serious buying mindset. And one of them is going to be the difference between nice to have and the need to haves. What I mean by that is, as buyers, a lot of times we'll have a lot of different preferences that we like in a home, but there's going to be some things in a home that if it has one of these issues, we won't even consider it. Like if you need to have a 3-bedroom, we're not going to waste time with a 2-bedroom or a 1-bedroom. Same thing if you can't do stairs because you have a knee injury, then we need to immediately cross off the 2 stories. So when we come up with this list of the need to haves, it really allows us to look at the market and to see which properties we should even consider and which ones we can cross off the list before even doing a tour for. Another thing that we like to do with our buyers, I call it the top 10 Discovery Channel list. So you might be familiar with Discovery Channel. They always have the deadliest animal shows or things like that. And each time they bring up like a shark or a tiger or a black widow, they always go in the lineup and they knock a different animal down on the list. I like to do this with my buyers with the homes as well too. So we're only really considering the top two or the top three homes versus considering 20 to 30 homes that we're seeing at any given time in a market on Zillow. And if we implore these decisions when we get into that serious mode, we really can have the speed of the decision versus the speed of the market. What I mean by this is the Bay Area moves extremely quickly. So most homes, they might go on Thursday live on Zillow and Redfin, and they'll have an offer by the next Tuesday. So we really need to be able to know what our criteria is so we can quickly go through the homes and we can determine if this is a home that is right for us to write an offer or if we should just say no and make the decision and keep looking for the next one. Now, part of that criteria and building the criteria, we need to understand the different types of homes and kind of what we're looking for so we can learn some of the real estate jargon when we're building out the search. So single family homes are going to be what most of us think when we say like a house, we're going to be thinking of single family home. It's going to be detached, no shared walls. It's going to have a yard, and the owner is going to be responsible for the maintenance for most of the upkeep, pretty much all of the upkeep, because most single family aren't going to have HOAs or homeowner associations. On the other side, we're going to have condos and townhouses. These ones typically are going to have shared walls. They might have monthly dues or the HOA dues. And HOA, as I said before, stands for Homeowner Association. So that could be something that covers the water, the garbage, the landscaping. It's really going to depend on the HOA. And that's part of the due diligence that we do with the different communities is we look at the different HOAs if it's a condo or townhouse. And some condos and townhouses, it's going to be like $400 a month. If it's a single family home, if it has an HOA, it's going to be typically lower. And then there's going to be some areas in San Jose, there's an area where it's like $1,000 a month for the HOA. And that's all going to affect the affordability as well. So we always need to make sure, even when we're getting the pre-approval letter, if it has an HOA, it could change the affordability for how much you qualify, because that would go into what you're responsible for paying each month. Next, we're going to talk about fixer-upper versus remodels. And this is really going to be more of a preference for what you're looking for in the home. If you need something that's going to be turnkey, you're looking for something that's updated and remodeled. A lot of buyers like to have that type of property, but that also means that it's going to be going for that premium price. So if we're not finding the right home, we might expand it a little bit into the fixer-upper range as well, where it might need a updated kitchen or it might need some new carpet or new paint. So depending on your, search criteria, it's going to affect the budget with which ones we're looking at. And both are going to have pros and cons, right? So fixer uppers, lower price, you can customize the home to be more what you're looking for, and you get that sweat equity for putting in the work. But sometimes fixer uppers, they have unexpected costs. So you might think that you only need to do a kitchen remodel, and then you find out that there's mold. And that could be an unexpected expense when you're going through this process of the remodel. Also, the time and the money and the effort to do the fixer upper and to remodel it is also going to be that opportunity cost as well, versus buying something that is just turnkey and ready to move into. So when you're ready to buy in the Bay Area, it's extremely competitive. And like I said before, it's competitive, but to bring some numbers to you guys, most of the homes for the whole county for single family homes, you might have in Santa Clara County 700 homes that are active on the market. And that's a county of millions and millions of people. So when we say competitive, we mean it's most of the homes are going to be having multiple offers, and they sell extremely quickly, like within a week or so for most of the homes, at most maybe 2 weeks. So what that means for you as a buyer is you have to be ready to look for homes 24 hours a day, 7 days a week, because you never know when the right one that's going to meet your criteria is going to pop up. And chances are, if you're interested in it, there's a few other buyers who are interested in it as well. So what that means is you need to be able to do the showings quickly so we don't miss the home. You want to make sure that you are able to review the due diligence documents as well. And we're just able to come to those decisions extremely quickly. And there's also going to be a few like key showing etiquette as well that I'd say. Like you want to remove the shoes or put on the shoe coverings before you go onto the carpet. You don't want to bring a big crowd of people when you're seeing the home because if it's very busy, we want to be in and out, especially if it's an open house. We want to be very efficient so we can see the most amount of homes. So there's going to be a few checklists, but we'll probably do a more in-depth consultation for you. And before we do a showing again, we'll remind you about all of the etiquette when you're actually showing the homes and you're actually seeing the properties.
Hey, Nick, quick question for you.
Yep.
You mentioned how competitive the market is in the Bay Area. Could you share, I mean, if you take a look outside the Bay Area, how long does it normally take to sell a home? How long is a property on the market for?
I'd say outside of the Bay Area, it could be like a month to 3 months is the time that it can take to sell a property.
Wow. Well, big difference.
Yeah,
Big
again,
difference.
it's gonna depend on the area. Different areas are gonna
Right.
be more competitive than others. But for us, typically we're seeing about 7 days to 2 weeks to go under contract. And at the height of COVID, it was some of the properties were going in 24 hours. I've had multiple offer situations where there's been 70 offers on a property.
Wow.
Um, yeah, one property I did even I had to stay up till 3 a.m. just to get it locked under contract in San Carlos because it was so competitive that on the first day I had I think 40 showings and we got it under contract the first day. So that's
Wow.
more of like a preemptive offer strategy, which we talk about with our buyers as well. Is sometimes you can't wait for the seller to be ready to take the offer. If it's extremely competitive and you think you might be priced out, you have to be a bit creative. And that's really what real estate is about in the Bay Area is it's so competitive for buyers that we have to figure out strategies to win you the right home. And that goes with the communication with the listing agent and it goes with the strategy that you come up with your buyer agent to make sure that you feel comfortable to pull the trigger and then you do what it takes to secure the property.
Well, thank you.
So please don't, guys. This is going to be the please don't section. Don't make negative comments about the home when we're viewing. These days we have so much ring cameras and camera devices in general that are set up with the Wi-Fi that you might not know that the seller or the listing agent is listening, but they are. And I think there was just a lawsuit about a buyer who made a comment during one of the listings and the seller heard the comment and when their offer came in, the seller countered them for a higher price because they didn't like the comment that they made. So we always want to make sure that we don't say anything about the property. I tell my buyers, don't even say anything that's good about the property. We can discuss after we go outside and we know that it's safe. But while we're inside, let's not make any comments about the property, good or bad. Let's just take the mental notes and then we'll do a debriefing section afterwards. Again, we don't want to bring a crowd to the property because we want to be very quick in and out. We want to see what it has to offer, get a feel of the property, and then we want to leave. And then please don't use the restroom when we're viewing the home. A lot of times the agents don't leave toilet paper, and it can make for a very uncomfortable situation. So we always want to go in between the showings, but at the actual property, we don't want to use the restroom if we can avoid it. So next, we're going to talk about a CMA, and this is going to stand for a comparative market analysis. So this is what we use to help understand what the property might go for in the market. And the reason I say might is the CMA is going to be using sold data for properties going back 3 months or so 90 days. And we're going to look for similar square footage, similar area, similar beds and bath. And then we also want to look at similar schools and other things that might affect the desirability of the property. And based off of this, we're going to get an average for the price for the homes for the price per square foot. And then we calculate that with the subject property and we get an answer for a range for what the property might go for. Now, the reason I say might go for is with the CMAs, it typically takes about 30 days for the property to close. And in the Bay Area, the market moves extremely quickly. So what my team does is we don't just rely on the CMA to let us know what the sold properties went for. We'll actually call the agents for the properties that are under contract and the other properties that are active in the area to get a sense of what the current pulse of the market is to give a better idea of what the value for the property is and what it would go for with the actual offer date. Now, again, if it's a multiple offer situation, we might have a CMA saying that a property is worth 1.7, but with bidding, it could get bidded up to 2 million or 1.9, depending on how much the other buyers want to put in for the property. So part of that negotiation when we're going through the offer is understanding what the other offers are on the table and then making sure that we're comfortable with the price that we're putting in, no matter what, the CMA says, right? The CMA might say one price, but we might need to be up here to get the property. And we need to understand that it might take some time to appreciate to get up to there. Or we might say, you know what, I think that it's above the price that we want to pay for the property. Let's move on to the next one. So offer process. We talked a little bit about this during that CMA preview over there, but you and your realtor decide what to offer on the property. And there's going to be lots of factors that go into that offer price, one of which is going to be the CMA, also the due diligence documents. We're going to take a look at the different disclosures and the inspections, and we're going to see what the condition of the property is. And depending on that, we're going to put in different contingency periods, which we'll discuss a little bit later in the seminar, what a contingency is. But based off of that, we're going to write up the offer. The agent then presents the offer to the seller, and the seller has three different options here. The seller can either accept the offer, they can counter the offer, or they can reject the offer. If they counter the offer, you have the ability then to either accept, reject, or counter. If they reject the offer, you can make another offer, but most times in the Bay Area, if you have multiple offers, typically they're going to counter them up to the highest, it's called the best and final offer for all of the different buyers. And then the seller is going to make a decision based off of those offers, which one they're going to actually be accepting. So this is going to be an estimate of the closing costs, and I'll go ahead and I'll let David talk about this one.
Thank you, Nick. So as I mentioned earlier, when we're going through the pre-approval process and identifying assets, I mentioned closing costs. Well, so this is just a snapshot of the types of items that are included in the closing costs. Typically, you can expect between 1 to 1.25% of your purchase price to be the total cost of closing. And what's included in the closing costs are things beyond the lender, but includes the lender fees, title company fees, escrow fees, no recording fees, transfer tax fees, some prepaid interest on the loan, on the new loan, etc. So that's why it's so important to verify assets for this particular item. As you could see in this particular example, when we ran this scenario, the closing cost came out to about $14,000. So as part of the pre-approval process, that's one of the items that we're going to be verifying, that not only do you have the funds for the down payment, but you also have the funds for these closing costs. And so now understand that closing costs will vary based on what's considered customary in a particular county, in addition to what you negotiate in your purchase contract. It's driven more so by county than what you negotiate, because if it's a seller's market, then they're going to be following what's considered customary in that county. So these figures can change based upon where you buy and what you end up negotiating in your purchase contract.
Thanks, David. So next, we're going to talk about the California purchase agreement. And typically in the Bay Area, there's going to be two types of purchase agreements that we see. One is going to be the California purchase agreement from CAR, which is the California Association of Realtors. And the other is going to be the PRDS. That one is typically more on the peninsula side. But both of these contracts are going to be very important that you understand before you put in the offer, because once we sign the contract and the seller signs the contract and notifies the acceptance, it's a legally binding contract. So it's really important that you sit down with your agent or your broker and you review to understand what all the terms mean and what the liabilities for you would be under the contract, and what the terms are, so you know what you're purchasing. The three most important things that we're going to be discussing with this contract are going to be the contingencies. So there's three contingencies that we typically see in a contract that are going to be there by default unless you remove the contingencies. Those are going to be an inspection contingency, a finance contingency, and an appraisal contingency. So the inspection contingency allows you as a buyer to go through the property, to get more inspection reports done, and to investigate the condition of the property. So you can get a home inspection, you can get a termite inspection. In the Bay Area, typically we see the inspection reports provided actually upfront because a lot of the sellers want that inspection contingency to be removed. But if we go through the reports and there's still unknowns that we don't feel comfortable with the property, we can always have that inspection contingency included, but it does make the offer a little bit weaker when we put it in to submit to the seller. Financing contingency is going to be about getting the loan and having the loan approved. This is one of the reasons why we always want to make sure that we have that pre-approval and we sit down with David to go over to make sure that he knows the full picture of the assets and knows the full picture of what's going on with the income, so he can tell us how confident he is on removing a financing contingency, or if we need to leave it in place because there's a few things that might need to go through the underwriting until he feels comfortable for us having it removed. Appraisal contingency is going to be based off of the appraisal for the property. So part of the loan process is an appraiser goes out. That's a third party, not related to the agents, not related to the lender, and they're going to determine the value that they see for the property on that specific date. Now, the appraisers use something very similar to what we had with the CMA, where they look at only the sold data for the property, and they typically go within a mile radius of the property to determine what the value is. So when we're doing the CMA, that's the reason why we look at the sold data, is we want to make sure that we can be as close as we can to what we believe the appraisal is going to come in at. And if not, we want to mitigate that risk as well. So those are the three contingencies. By default, you're going to have them in the contract, and they would have a 17-day period. And the cool thing about contingencies is they need active removal. What that means is when your contingency period expires, it doesn't actually expire. You would have to remove it as a buyer with a contingency removal to take that contingency off. Now, a lot of times in the Bay Area, it's such a competitive market that we do see buyers put in non-contingent offers. That would mean that they would remove all of the contingencies. And if you put in a non-contingent offer, a lot of times your deposit, which would be the 3% earnest money deposit, it could be at risk due to the liquidated damages clause of the contract. So you always want to discuss with your agent and your broker, the liquidated damages clause. You want to discuss the contingencies and come up with a strategy that you feel comfortable. Because if something goes wrong, if you have the contingencies, there's a good chance that you get your deposit back. If it's a non-contingent offer, there's a good chance that the seller would keep the deposit.
And question there, Nick. So are you saying then the contingencies kind of protect the deposit up front,
Yep.
the buyer's deposit, until they could see
Yeah.
these, until they can complete these steps?
Yeah, so I always recommend that the buyers talk to the broker or to the agent about the specific situation, because sometimes buyers think if they keep a finance contingency that they would be able to get out of the contract if they find something with the foundation or something like that, right? And the contingencies do have a very specific section in the contract where it goes over what justifies the contingency and what doesn't justify the contingency. For example, if you remove the appraisal contingency and you have the loan contingency and the appraisal comes in low, that doesn't automatically mean that you can walk out of the contract just because you have the loan contingency. So it's important to understand all of the contingencies with your agent and the implications of them. But if you have a fully contingent offer where you have all of your contingencies and there's something that you discover, if it falls under the contingency terms, then yes, you'd be able to submit a cancellation and say, hey, due to the good faith clause here with this contingency, I am canceling the agreement and I am asking for my deposit back. And then when the seller signs off on that, you get the deposit out of escrow.
Okay. Thanks for clarifying that.
So know your team. When we're going to battle for you in Silicon Valley, as we talked about how competitive it is, you're the CEO. You're the one who's managing all of us. You're hiring us as your team. So the lender is on your team, the agents on your team, our assistants are on your team. You're basically building out a small company that's whole design is to be extremely efficient and to help you win the home. And that's how we want to keep you. We want to keep you in the driver's seat, in control. So you're the one who's calling the shots and you're the one who feels comfortable about finding the right home for you. Cool. So it looks like we're going to the questions section.
We got two questions. The first question, if I'm between jobs, is it not even worth getting pre-approved?
Well, I think I'll take that one, Nick. We do need to have some source of income. So if you're in between jobs and you currently don't have income, employment income, it's kind of hard to get you pre-approved for anything. But it doesn't mean you can't. It just means that once you get started working again, we can use an offer letter of that new employment to get you started, and we can wait until the pay stub shows up in order to close. But yeah, you kind of have to have some income to be able to substantiate your ability to pay the debt.
Cool. And just to follow up on that one, David, a lot of times I know for my clients, I've heard when they're switching jobs, it's better if they're staying within the same industry. So if they're in tech, if they're going to a different tech job, they might not need to have, the 2 years of the, payment history with that employer. But if they're completely switching to a different industry, it might make it a bit more complicated. Is that
Yeah,
correct?
that is true, Nick. That's a good point. Yeah. If you're looking into buying a home, there's a couple of things you should try to, you know, be aware of, and exactly what Nick states is that if you're thinking about changing careers, you're going to want to think about that before you get into trying to buy a home, because depending upon your change, if you're going from a salaried position to a commission position, that could create a problem, etc. So you want to have a conversation with a lender before you make that change, because it could impact your ability to buy. In addition, um, when we're also relying on bonuses or RSUs, restricted stock units that are offered by a lot of electronics companies or high tech companies, when you change jobs, we can't use that bonus income or that RSU income at your new job because you don't have a 2 year history of it. So it's really important that you kind of plan these things in advance, so you don't put yourself in a situation where you kind of you know make a misstep, and then you can't use your bonus or RSU income if the type of position you have relies on a lot of that. So yeah, there's a couple of tech items there that people need to be aware of. But I would just advise you that call me, talk to me about your scenario before you make a jump, before you make a move, so I could tell you what the implications are of those scenarios.
Okay, and then going off that, if I hold unvested RSUs for my employer, am I able to use them as collateral to obtain a loan for a down payment?
Uh, Technically, no, because the unvested RSUs are not yours yet. But we can use RSU grants or vestings as they occur as income. So a lot of employers, what they provide now is RSUs as a part of your compensation. So what we do is we'll take a 2 year history of the RSU vestings, determine the value of those vestings, and then add that to your income. But if they're unvested, they're technically not yours to put up as collateral. So when they're unvested, that basically means that something that's coming, but hasn't you haven't received it yet. So we can't use unvested RSUs.
Okay. And can unemployment work towards the pre-approval or enough in investment assets?
Unemployment compensation is not an acceptable income source, because typically it's temporary. We have to show that your income for the particular source is likely to continue for 3 years, at least 3 years. Unemployment doesn't run out that far, so we can't use unemployment. Um, as far as real estate, other real estate assets, if you're generating income from that real estate, and you could prove it up with tax returns, definitely we can use the income generated from those real estate assets, um, as long as we have tax returns to substantiate the revenue streams. Um, Again, there's these rules and regulations that came into place from the 2007-2008 market crash that now requires lenders to show the ability to repay. It's called an ATR, or ability to repay rule. And that means that we have to show that you have the ability to repay utilizing standard underwriting guidelines, Fannie Mae, Freddie Mac, FHA, VA, whatever the lender requires. But these rules are in place to avoid some of the scenarios that occurred back in 2007, 2008.
Okay, and then would a person receiving Social Security and pension be likely to get a loan or likely to be rejected?
Well, whether you're accepted or rejected, it's more about whether we can use that income, and we can. Social Security we can, pension income we can, interest income, dividend income, as long as you have a history of it, or if you just started receiving Social Security, as long as we have verification that you started receiving it through an award letter, we can most definitely use that. That's not a problem. Yeah, we can use distributions from your 401k accounts, as long as you're above the 59 and a half, and you set up your distributions on a recurring monthly basis without expiration. We can certainly use that distribution as income as well. So, I've helped many clients who are are receiving Social Security and some pension income. I help them qualify by using distributions of their 401ks or other retirement accounts as part of their qualifying.
Okay, and I guess this is going back to when Nick said not to make negative comments and the lawsuit. How did they determine that the price raise was due to the comment? I don't see how causation could show up.
I'm not sure what the article was exactly, but I do think that I did see that they found out somehow that it was due to the comment. Again, since this is a third party news article that I read, I'm not going to speak too much on it. It's just if you Google comment during showing led to buyer paying increased price, I'm sure Google or ChatGPT will show you the article. But I'm not going to verify third party information.
Okay, it looks like that's all the questions we have for today. If you guys do think of any more questions, here's David and Nick's contact information. You could always reach out to them personally. And again, a copy of the slide deck will be emailed to everyone, so you'll have their contact information in your email in about no later than a week. So thank you everyone for joining us today, and have a good rest of your day.
Thank you, folks. Thanks for
Thanks,
joining
guys.
us.